Have you seen what's happening with silver lately? It's wild. The price has been on a roller coaster, and a lot of people are left scratching their heads. So, what's the real story behind silver's recent price crash? Let's break it down. First, let's talk about the paper market versus the physical market. The price you see on your screen, the one that's been dropping, that's largely driven by the futures market, specifically on exchanges like COMEX. This is the paper silver market, where contracts for future delivery of silver are traded. Big players like hedge funds and banks can use massive amounts of leverage here. When they decide to sell, they can push the price down hard and fast, even if there's no change in the real-world supply and demand for actual physical silver. And that brings us to the great disconnect. While the paper price has been falling, have you tried buying physical silver? It's a completely different story. Go to any bullion dealer and you'll see premiums, the amount you pay over the spot price, are sky high. Sometimes you can't even find popular items like silver eagles or maple leafs in stock. Dealers are reporting record demand, and mints are struggling to keep up. So why is this happening? On one hand, you have the paper market, influenced by things like a stronger dollar, rising interest rate expectations, and general fears of a recession. Traders are selling off assets, including silver futures, to reduce risk or cover losses elsewhere. This creates downward pressure on the spot price. On the other hand, you have the physical market, where real people and investors are buying silver as a safe haven asset and a hedge against inflation. They see the lower spot price as a massive buying opportunity. This surge in demand for physical metal, combined with existing supply chain issues, is what's pushing premiums up. Basically, there's a tug of war. The paper market is saying silver is less valuable, but the physical market is screaming that it's more valuable than ever. So what does this mean for you? It highlights the difference between owning a paper claim on silver and holding the actual metal in your hand. The paper market can be volatile and influenced by financial maneuvering that has little to do with the physical fundamentals. The physical market, however, reflects genuine supply and demand. This situation is a fascinating case study in market dynamics. The paper price can only detach from physical reality for so long. Eventually, something has to give. Will the paper price snap back up to reflect the physical demand, or will the physical premiums eventually come down? History suggests that physical fundamentals tend to win out in the long run. It's a reminder that when you're looking at silver, you have to ask yourself, are you looking at the price on the screen or the price in your hand? What do you guys think is going to happen next? Drop your thoughts in the comments below. Thanks for watching. And don't forget to like and subscribe for more insights. See you next time. Did you see the recent plunge in silver and wonder what on earth just happened? Let's break it down, because the story the screens are telling you is not the whole picture. Nearly all the major selling pressure happened during peak U.S. futures hours. When New York opens, volatility expands. When liquidity thins out, algorithms take over. Now, this doesn't automatically scream manipulation, but it does mean that futures positioning can shove the price far away from short-term fundamentals. While the paper market was getting hammered, something else was happening. In parts of Asia and the Middle East, physical buying reportedly stayed firm, even got stronger. This divergence is critical. Why? Because futures markets can move billions of dollars in paper silver in mere minutes. Physical markets move slower, but the supply is much, much tighter. Think of it like a race between a sprinter and a marathon runner. The sprinter is fast and flashy, but the marathon runner has the underlying endurance. Now let's talk about something called vault stress. It's a key piece of this puzzle. Exchange vaults, like the COMEX, operate on confidence. Most participants don't actually want the physical metal. They just roll their contracts forward. Very few ever demand delivery. That's totally normal. But what happens when that changes? What if delivery demand starts to rise while the amount of registered available inventory starts to fall? The system's sensitivity goes through the roof. Even small imbalances can create huge outsized price swings. This isn't just theory. We've seen this movie before. Back in 1979 and 1980, silver experienced extreme volatility during a physical squeeze. The paper markets completely disconnected from the physical premiums for a while. Eventually, the price had to reconcile with reality. Now, this is important. History doesn't repeat perfectly, but it often rhymes. When you have structural deficits for multiple years, and you pile a mountain of leverage on top of a tightening supply, the whole system becomes fragile. And fragility creates violent moves, both up and down. So, how do people react when this happens? I see three main groups: the panic sellers, the confused observers, and the strategic accumulators. The panic sellers are glued to their screens, reacting to every flicker of red. The confused observers are frozen like deer in headlights, not sure what to do. But the strategic investors? They're studying the structure. They're looking under the hood. The key is understanding what you actually own. If you hold physical metal, you hold a real, tangible asset. If you hold a leveraged paper position, you hold counterparty risk. Those are two very different things in a fragile system. Here's the beautiful paradox of this market. Lower paper prices often trigger a surge in physical demand. People see a bargain and they buy the real thing. This tightens the available physical supply even further, which increases the stress on the vaults, which can eventually force a major repricing upwards. The paper market can absolutely steer the ship in the short term, but it cannot manufacture physical silver. At some point, fundamentals always reassert themselves. The only real uncertainty is the timing, and that's where most investors lose their discipline. So instead of asking, why did silver crash? We need to ask a much better question. What changed structurally this week? Did industrial demand suddenly evaporate? No. Did a bunch of new mines suddenly flood the market with supply? Not at all. Or did leveraged positions get unwound during a period of thin liquidity? That seems much more likely. And that distinction matters more than anything. Because if this was just leverage-driven volatility inside a structurally tight market, then what we just saw wasn't a collapse, it was a stress event. And stress events often precede much larger moves. I'll leave you with this thought to chew on. When the paper price falls but the physical market tightens, you're not looking at a simple supply glut. You're looking at a system under immense pressure, and pressure always finds a release one way or another. The only question is whether you're going to react emotionally to the screen price or position yourself intelligently based on the underlying structure. I want to know what you think. Drop a comment below. Do you believe the futures market still has total control over silver? Or will physical availability and real-world fundamentals ultimately dictate the price? If you want more of this kind of structural analysis, and less of the noise and panic, make sure you subscribe to Bullion Alert HQ. Because in markets like this, understanding beats panic and discipline beats emotion. Thanks for watching, and I'll see you in the next update.